Welcome to this video on how to develop a balance sheet. A balance sheet is a financial statement that provides a snapshot of the company's financial position at a specific point in time. It shows the company's assets, liabilities, and equity. First, let's define some key terms. Assets are the resources that a company owns and expects to provide future economic benefit. Liabilities are obligations that a company owes to the others, such as loans and debts. Equity represents the residual interest in the assets of a company after liabilities are paid. The balance sheet is structured in a specific way. On the left side, it lists the company's assets. These can be divided into two categories: current assets and non-current assets. Current assets are assets that are expected to be converted into cash or used up within 1 year. Examples include cash, accounts receivable, and inventory. Non-current assets are assets that are expected to provide economic benefit for longer than 1 year. Examples include property, plant, and equipment. On the right side of the balance sheet, the company's liabilities and equity are listed. Liabilities are also divided into two categories: current liabilities and non-current liabilities. Current liabilities are obligations that are expected to be paid within 1 year, such as an accounts payable and short-term debt. Non-current liabilities are obligations that are not expected to be paid within 1 year, such as long-term debt. Finally, equity represents the residual interest in the assets of a company after liabilities are paid. It can be divided into two categories: shareholder equity and retained earnings. Shareholder equity represents the ownership interest of the company's shareholders. Retained earnings are the profits that a company has earned and retained since it was founded, minus any dividends paid to shareholders. Now that we have a basic understanding of the components of a balance sheet, let's talk about how to develop one. The first step is to gather the necessary financial information. This includes information on the company's assets, liabilities, and equity. You will need to have access to the company's financial records, including its income statement, cash flow statement, and general ledger. Next, you will need to classify the assets and liabilities as either current or non-current. This will help you to understand the company's liquidity, or its ability to pay its short-term obligations. Once you have gathered and classified the financial information, you can begin to organize it into the balance sheet format. The assets should be listed in order of liquidity, with the most liquid assets at the top. Liabilities should be listed in order of maturity, with the most short-term obligations at the top. Finally, equity should be listed at the bottom, with shareholder equity followed by retained earnings. It's important to note that the balance sheet must balance. This means that the total value of the company's assets must equal the sum of its liabilities and equity. This equation can be expressed as follows: assets equal liabilities plus equity. So, to review, a balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It shows the company's assets, liabilities, and equity. To develop a balance sheet, you will need to gather financial information, classify assets and liabilities as current or non-current, and organize the information into the balance sheet format. The balance sheet must balance, with the total value of the company's assets equal to the sum of its liabilities and equity. I hope this tutorial has been helpful in understanding how to develop a balance sheet. Thank you for watching.